What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is May 22nd of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I've got to do something that I don't always do here on the channel, guys. You all know that we do daily updates here where we're usually analyzing the kind of short midterm perspective on Bitcoin, altcoins, the stock market, the whole macro picture of what's going on. And we talk about short-term price action predictions and where we really see things going. But in today's video, I need to talk to all of you out there here on the DataDash channel, and those of you who are maybe watching for the first time. If you have the time, this is a video that I recommend you stay around for. This is not going to be a typical daily update, because today I really want to go big picture. I want to talk about how the next couple of years are likely going to be very different from the decade of the past. And if we are trading and investing in the mindset of the last decade, how it could be incredibly dangerous going into the next couple of years. This isn't some doom or gloom thing, but rather something we should all be aware of when it comes to trading and investing in Bitcoin, altcoins, and stocks. If you guys happen to stick around for the video and you enjoy my rambling, consider dropping a like. It's one of the greatest ways you can support the channel. And we're going to kick off the rambling right now, but I want to go ahead and before we do that, just let you all know that I've got a webinar that I'm going to be hosting later on today over on the Bookmap YouTube alongside Bruce, where we're going to be talking about how I utilize Bookmap as an application, one of our partner tools we will use later on in the video. You guys can sign up to their YouTube channel as a subscriber to get notified of that, hit the bell icon so you don't miss that, but it'll be around 10 a.m. Eastern Standard Time. Now, I've talked a good amount here about what we're going to be discussing today, and I want to go ahead and kick off by obviously taking a look at the short term before we dive into the long term. A lot of people have been relatively disappointed who are starting to buy into Bitcoin, buy into Ethereum, believing that we're in the next bull market. And it's understandable why people are in this position, guys. I don't mean to berate anyone. You all know our short-term position is that this isn't a new bull market, that we are going to be correcting. And I'll explain that as we go more to the long-term analysis, but I can understand why a lot of people saw the FTX collapse as kind of the end and end-all be-all of the bear market for crypto. It was a pretty big flush on the industry. A lot of players got knocked out, and ever since then, Bitcoin has accelerated from around $16,000, $15,000 all the way up towards $26,800. Still a very sizable move with a relative high at around $31,000, practically doubling from those lows, a 100% move. Now, I understand because of that, a lot of people might feel FOMO, but this is again where I think a lot of people are going to get tripped up, and it's important to understand why the last decade worth of price action for Bitcoin and the kind of responsiveness to just buy the dip and buy the typical correction in Bitcoin is not likely going to be a winning trade going forward into the next coming years. Let me explain. First off here, we can obviously see there's been weakness in the short term. But if we take a look here at our partner tool Bookmap, we can see that over the last week, and this has been consecutive for practically the past month, every time we check it here on Monday, that the cumulative volume delta is massively negative, minus 10,000 here on Bookmap's multi-book order book. We can see that time and time again here, there is massive market order flow, outflow out of the market. People are not rushing from cash into Bitcoin, they're rushing from their Bitcoin positions into cash. And they're likely withdrawing it, sending to bank accounts, getting it out of the crypto ecosystem. Liquidity is essentially drying up. We've talked about this with stablecoin liquidity. We've seen it here in Bookmap, here in the order books. And the question remains, why is this happening? Why aren't people essentially taking this dip opportunity and driving up prices to new highs like we would in a normal bull market? Well, the reason is not only because of stablecoin liquidity being lackluster in the crypto space, as we've already discussed, but it has to do with the changing tides on the macro stage and what it has to do with global central bank liquidity. Now, I want to go ahead here and talk a little bit about some important charts you guys should see. It's one thing to analyze, Bitcoin and analyze the stock market, but mainly I want to go ahead and talk about what's been going on in some of the other macro measurements that people simply aren't watching. For the past couple of months to the past year, we've been sold on a ton of different narratives, really since crypto has started to move up. Bitcoin is starting to rally because there's a bank run and people are taking money from the traditional financial system and putting it in Bitcoin. We've seen through stablecoin liquidity and obviously now with the market order flow that is just not the case. Since back in March, there have now been more weeks here where we've had red cumulative volume delta, more market outflow than market inflows. So that retail investor or institutional investor outflow from traditional banking system is not happening. Okay, then what else? Well, we've heard that BRICS, the Brazil, Russia, India, China, and South Africa alliance, with a whole range of other nations that might be joining the BRICS alliance, they are now going to create a new currency to compete with the dollar. And the dollar is absolutely set to fail because of this, because now the global economy is going to try to circumvent its world reserve currency status. Well, ever since that narrative has really been paraded here, the dollar has been just fine. In fact, it's pretty much where it was back here in January, December of 2022. And it's actually not only continuing to curl up here, but on the weekly has had its first blue flip on our momentum indicator since as far back as June of 2021. We all know what happened last time we got the blue flip. Essentially, the dollar rallied on the Dixie, which is a dollar measured against other world global currencies, from 91 points all the way up towards 115. It was not a time to be short the dollar, but rather be betting on the dollar to the upside. So why is the dollar moving higher here? Obviously, this shows that a lot of the BRICS narrative falls under its own weight. And the reason for this is because a world reserve currency, or a store of value, if you will, if you think about the range of fiat currencies, is going to be in a nation where people are immigrating to the nation, people want to store wealth, they feel that their money is safe there, that it will be untouched by governments or tyrannical governments, and essentially there's a desire for people to move and do business there, right? And that's why the US and the EU as a whole, the Eurozone more specifically with the Euro, are two of the world predominant world reserve currencies, and why people rush towards investing capital and resources into those economies. So I don't know if we would say we feel the same way, as much as I have nothing against the countries of India and China and Brazil and Russia and South Africa. I've been to some of them before. They're great countries in many ways, but even these nations themselves don't trust each other. They don't speak a similar common language. And because of that, these types of things that the United States or European economies have, whereas these BRICS nations don't, make it so that they cannot be world reserve status ranges for monetary value. It's simple as that. That's the key problem here with this narrative. So, okay, we've heard de-dollarization, whether or not you agree or disagree with me on that, that's why I feel the narrative falls through. While we haven't seen the dollar collapsing, it's clearly not showing in price. Well, we've also talked about how the bank run fallacy that's going on, that Balaj and many people promoted in the crypto space, is not true. What really could drive Bitcoin higher here? Well, the narratives have already been relatively weak. And I got to be honest with you guys, I've looked long and hard to try to find what could really drive Bitcoin higher. And I think the big thing at the end of the day people always come back to is they say, well, you know what? The Fed is just going to print more money. Right? We've seen what the Fed does. They say one thing and they do another. They're going to go ahead and they're going to say whatever to inflation. They're going to pivot because there's going to be something that slightly breaks in the economy, like what we saw back in March, and they're just going to print money and Bitcoin's going to go up again. And it's going to set new all-time highs. That's the narrative that I've seen everyone fall back to, where they kind of shrug their shoulders and say, no, I'm a bull. I believe that things are going to go up because I've learned not to trust the Fed. And to be honest, that skepticism is pretty well founded. The Federal Reserve does not have the best track record of being honest. But I have to let you guys know why this time is really different. And it's not a one-off event here that I'm trying to propose. This is something that the Fed gets itself caught in every couple of decades when monetary policy as well as physical policy and the federal government is mismanaged. And that happened in 2020 with COVID. The last decade of stimulus had minimal to no effect. We had practically no inflation in the economy, assets continued to move higher, and even people such as Janet Yellen, who's the Fed chairman, believed that we were in a period of time where we would never see a recession again in our life. The Fed had almost perfected its means of predicting monetary policy output into the economy and being able to keep things at a consistent rate, keeping inflation around 1% to 2%, roughly around its target, or slightly below it. However, that changed when we started giving stimulus checks to everyone, when everyone started to go home, when the labor market experienced major discrepancies and left staggering effects on the economy long term. Since then, we've essentially seen that bond yields have started to move higher substantially since 2020, going all the way up towards around 4% for the US 20-year yield. This has been following the Fed's necessary contraction of monetary policy. In order to rein in inflation, they have been raising interest rates, they have been essentially lowering their balance sheet in order to cut out M2 or the money supply and start to contract credit in the economy. This is a normal, reasonable response. If what caused a lot of the inflation was easy money and a lot of excess money printing, you're going to have to do the opposite of that. You can't just sit there and hope that it goes away on its own, right? Inflation is not something the Fed or any politician or financial system can just turn a blind eye to. It doesn't discriminate. It is a problem that only gets worse because inflation starts to change the perception of people's minds, and people start to make it even worse by starting to buy things that they usually wouldn't buy, driving up continuous demand in the economy, and essentially eating up any available supply and leaving prices at a much heightened rate, and essentially getting towards a point where people lose trust in the system, the value of money, and then you get hyperinflation. The Fed and every other central bank does not want this. There's plenty of history over the last couple of centuries where essentially if central banks do not react and they do not rein in this inflation with every monetary tool they have, it is going to be much worse down the line. And Jerome Powell and the Fed know this. So I want to go ahead and talk here a little bit about some important things we can pull from these charts. Now, the US 20-year yield here, we don't have as much data, unfortunately, because it got cut off by TradingView here. I don't really know why that is, but we can take a look here at the US 10-year yields. And I want to go ahead and really demonstrate a very fascinating chart here, right? You know, most traders out there in the crypto space are not going to be looking at bond yields. I know it sounds kind of boring. This is not some crazy 10x altcoin that's going to double your money or 10x your money in the next couple of days. But this chart right here will tell you a lot more than the vast majority of crypto influencers who are just saying it's another bull market because the Fed's going to come save the day. This chart will tell you all you need to know. It is the 10-year yield for government treasuries in the United States. And if you take a look over the last couple of decades, really since back here in 1988, we can see in our momentum indicator that we have been trending downward when it comes to the interest rate on these treasury notes or these government bonds. In fact, so much so that they went from an average rate of around 8-9% down towards just 0.5% over the past 35 years. So we were in a multi-decade downtrend here for bond yields. And this was due to the fact because the Fed, time and time again, when something would go wrong, they would lower interest rates. They would continue stimulus in order to continue propping up the economy, innovation in various sectors. And during this period of time, we saw a lot of great things. We saw the internet come out. We saw massive advancements in pharmaceutical and biotech. We saw massive expansion of new hardware devices, not just personal computers, but we saw the iPod. We saw the iPhone. We saw so many amazing technological advancements during this period of time. All kinds of things. I'm not even mentioning all of them here. Social media, YouTube, all these different really cool technologies that came out and completely built new businesses that just didn't exist before. And that was a high growth expansionary period where interest rates were low, capital was cheap, the Fed was printing money when things went wrong, and it seemed like for a long period of time, this was able to work. And it did. There was lots of innovation, there was growth, there was stimulus in the economy. However, this is very similar to the 30s and 40s in a lot of ways. As we were entering into World War II, the government printed a ton of money and was able to essentially, through a war, dig itself out of a recession. And as we started to see a massive expansion of the suburbs and growing out in the United States and basically the post-war recovery, this again left us in an environment of relatively higher inflation and fast growth. But after that, we started to get into a period where interest rates had to expand higher, especially as we got into the 70s and the 80s. And you can see the bond yields followed suit with the federal funds rate. So, the question here is that now, for the first time since back, outside of a small anomaly here in 86, first time since 1951, here in 2022, on the 12-month candle, the yearly candle, we've had the first blue flip on the US 10-year yield. And I bet if you could find the price action for the US 20-year yield, you could take a look at the shorter-term bonds as well, backtest me on this, you're going to get the same thing across all those time frames. And this one chart right here is the problem for Bitcoin and cryptocurrencies and meme stocks and Dogecoin and everything that you can think about that would have done well over the last decade. Why does this chart matter so much? It matters because bonds, essentially, especially US treasuries, are seen as a guaranteed rate of return. They are one of the most sound assets in the world. We can talk about how much we hate the United States, or, oh, maybe the US, does this overseas and therefore it's a really bad country, or whatever. We can all be opinionated on the United States. But at the end of the day, the United States does have the world reserve currency. The United States dollar is still in one of its strongest positions it's been in over the last few decades across various world currencies. And during inflationary periods, people are looking to the dollar because their currencies are much worse than the United States in many cases, not in all cases, but you get my point here. The United States, while there is a narrative going around about it being in a bad position, is in a much better position than most nations here. And it is the bastion of hope and where capital goes to preserve itself during these periods of uncertainty and slowing growth. All right. So the point I want to make here is that as bond yields across the globe go up, especially US Treasuries, which again are utilized in metrics or measurements like the Sharpe ratio, we can start to see why this is a big deal for people. Because as those bond yields start to move up from where they were back around, say, here in January 2020, when they had a low of 0.33%, even lower than 0.5%, and are now sitting at 3.65%. Albeit slightly lower than the 4.2% paid back towards the close of the year in 2022. We'll likely get back up there soon. You need to start thinking about from an institutional investor's perspective, or someone who is having their money in a 401k or IRA, or has their money in a hedge fund. The question you need to ask yourself is, how lucrative do interest rates need to get, or the yield more specifically on these bonds, which are going to go up if the Fed's rates are going to continue to go up? How lucrative do they need to be to completely crush any desire to buy crypto? Because if I know that I can put, $100 hypothetically into a bond, and at the end of the year, I can get $3.65, right? Or I scale that up to $1 million and I can make $36,500. Am I really thinking about speculating on crypto? Now, sure, maybe someone with $500 isn't interested and they're going to go gamble on cryptocurrencies. But I got to be honest with you guys, that $500 investor is not what drives Bitcoin's price. You need hedge funds. You need institutions. That is why everyone has been talking about the corporate treasurers, all this stuff, the micro strategies, the big potential players, whether they be corporations or investment funds or banks. That is what could really drive up Bitcoin long term. But all that capital is now looking at a risk-free investment. Government treasuries. Practically risk-free, getting 3.6% and likely a yield that is going to continue paying higher for a long period of time. That's a pretty sweet deal. And if we start to see rates going up here historically to where they were, say here in 1967 or here in the early 2000s, where we start to get rates in an uptrend, it is going to become more and more lucrative to be a passive investor in bonds. Not into stocks, not into meme coins or meme stocks, and definitely not into cryptocurrencies, even cryptocurrencies like Bitcoin. And this is the big problem here that so many people don't focus on. As the federal funds rate here continues to expand higher, its highest point since back here in 2007. And along with that, we see the US central bank balance sheet continuing to contract here. We've got the red flip on the weekly, one of our biggest declines here, $58 billion in 1 week from April 24th to May 1st. It becomes clear here that the Fed is not done doing its job. That while a lot of people thought, the Fed would only take interest rates to 2 or 3% back a year ago when we were shouting 5% or more, it's looking like 5% may not even be enough here. Because if Bitcoin is rallying from 16,000 to 26,000, right? What do you think Jerome Powell is thinking right now? What do you think's going through his mind when he sees financial assets propping up like this? He sees that there's still too much money in the system. Too many people speculating and buying assets that they don't really need to be buying right now during what should be a recessionary or contractionary period. What do you think Jerome Powell thinks when he sees the stock market rallying back up here to where it was back in May of 2022? Or more specifically, when he sees investors trading stocks like Nvidia towards a price to earnings ratio of 181 simply because of future expectations for AI. I think he's not happy. And in fact, I think a lot of Fed governors out there are not happy because they're not only seeing that financial assets are being propped right back up to ridiculous valuations, but they're also seeing that inflation is relatively sticky. The CPI is declining to some degree. It's a very easy indicator to be manipulated because of energy prices. But if you take a look at the things that are sticky, like the cost to rent, home prices, general goods and services in the economy, we find that inflation is still relatively strong right now. And the Fed is realizing, as it has time and time again, even back when they said that inflation was transitory, all this BS, it just doesn't make sense and was passive monetary policy mismanagement. They are now realizing that it's time to batten down the hatches. Jerome Powell is like Paul Volcker of our day, potentially. If he continues to do things right, he is going to, like Paul Volcker, make up for the mess that he made alongside other Fed chairmen over the last decade and the mismanagement during COVID and beforehand. And it is going to be a difficult period, but if the Fed does it right and they are swift about it, he can go down as a celebrity in the Federal Reserve. He can be someone who essentially saved the day when no one else was willing to. And instead of being someone who's passive, take it by its horns and deal with the issue right here, right now. Not being passive about it, but being essentially the leader that we need right now in order to contract monetary policy and get us back towards an equilibrium between supply and demand. Not propping up Bitcoin or other assets right now when we are trying to deal with the brutal issue of inflation that, if not dealt with now, is only going to get worse. Now, as you all can tell, I'm a little bit opinionated about this because I like to study the long term. And I know that the last thing we want is some absolutely end-all be-all inevitable hyperinflation, collapse of the financial system. I know some people would love to see it burn and they want to have something new and they think Bitcoin is going to be the answer to it. I gotta be honest with you guys, that's not how it's going to play out. If the dollar itself loses world reserve status, if we see BRICS take off as being the lead world reserve currency, if we somehow just turn a blind eye to inflation, the world is going to be a much darker place than it is right now. I can guarantee you that. The stability that we take for granted in this world will be at severe risk, and we are going to be in a dark period of time, much darker than any potential recession where the Fed may continue to raise interest rates, deal with the issue now, have a short-term downturn in the economy, and then we go back to pretty much the way things were, essentially, or at least some degree of it, maybe not as optimistic or as stimulatory as before. This is why when I talk about Bitcoin, when I see these moves here, why I see these as relief rallies, what we've seen since back in November. And I understand it can be painful to sit back and watch some of those moves and think, man, I should have bought that. But you want to know what's much more painful? Buying into this relief rally after already facing losses since the last bear market and getting trapped in a much further downward move. I want to go ahead and kind of bring up one chart here. I think it's a relatable example because I think crypto is very much gone through its .com bubble. If we take a look here at the NASDAQ, one good thing you really have to be prepared for is imagining that 65,000 was the equivalent of the March 2000 peak in the .com bubble, where for nearly coming up on a decade and a half, we did not come back to those all-time highs. I'm not here to say crypto is dead. I'm not here to say that your favorite altcoins aren't worth anything. They may very well be, and Bitcoin will likely go back to set new all-time highs in the future because if we know anything, the number generally goes up and to the right over the long term, and on top of that, the Federal Reserve will usually print more money. The balance sheet isn't likely going to be going down forever. I'm not here to make those kind of silly arguments. What I'm here to say, though, is that that's over the long term. That's over a multi-decade horizon. And you may very well be getting trapped into buying into positions here that are in the midst of the heightened range of a bear market. It may take years and a lot of emotions to get back to that point where they were before. And I can promise you all this, whereas we may hope that the Fed will do one thing and may save us, the Fed has a job to do. Jerome Powell and some of the previously more bullish and more kind of euphoric stimulatory Fed governors, even they know this. And it is why month after month, FOMC meeting after FOMC meeting, the prediction markets go from practically no one believing that the rates are going to move higher to 25, 50%. Oh, no, we're going to raise another 25 basis points. Inflation isn't done yet. Something we have been berating here on the channel time and time again. I wish there was an easier answer, guys. You know, as a content creator here on YouTube, I don't benefit from being bearish. I would, you know, if I, at the end of the day, if I didn't have any morals, I'd be, you know, showing you guys my Bybit referral links, telling you need to go all in with your money, move it out of your bank account, use my link, and generate a ton of trading fees for me through your liquidations when you inevitably trade with too much margin and get stopped out or get liquidated, and I make money from that. I could do all that, but I don't want to, and it doesn't feel right to do that. I want you guys to prosper. I want to grow alongside you guys. I want you all to do so damn well over the next couple of years. I want you to be able to capture the next big moves. But we got to know when it's time to actually strike. We got to be mature enough to not let our emotions get the best of us. And there's nothing wrong with doing some short-term trading, but if you're going to do that and trade these relief rallies, you got to know when it's time to get out. You can't fall in love with your positions like so many people inevitably do. Statistically speaking, people will lose during these recessionary environments trying to trade too much. In fact, that is a part of this equation. Jerome Powell, the Fed, through what I call the liquidity trap, wants people to do this. They need to test the waters. That's why they stop raising interest rates sometimes to say, hey, what happens here? Do the markets start reacting? Do they start propping up assets again? If so, there's too much money in the system. What the Fed knows we need is a 40, 50, 60% correction in the stock market. We need to flush out the past couple of years of optimism. And it makes sense because the physical economy itself has started to slow down. How is Amazon going to double as a company from its current valuations after we had peak e-commerce use back in 2020? How are Google, companies like Meta as well, how are these companies going to justify rallying their stock valuations back when in reality the stock value of these companies and assets as a whole are off of future potential growth? What growth is there left? These technology companies are already embroidered into our society to such a deep degree. We need new market leaders, and this is one of the big telltale signs that this is a fake out bear market relief rally. I'm just trying to be realistic with you guys here. It's not about capturing every move. It's about knowing which moves are the absolute high return potential, low risk trades that you can get into and that are going to help you to come out on top. So think about what you can afford to lose, not what you can afford to make. I'm going to say that time and time again here on this channel. And if you guys like these time-tested statements, if you like my rambling, consider dropping a like. And if you guys want to support the channel in any great way, while we do have sponsors, we have the Dash Report, where I do a 20-page plus newsletter every month where we talk about these things. We talk about crypto stocks, commodities, and Forex. We go through in our article portions and talk about how the Fed sends us clear signals about what they're going to do and how this is going to be a long-term change, guys. The dollar itself, bond yields, if this isn't enough to tell you that it's going to be incredibly difficult to promote assets, especially those that don't pay a dividend or guaranteed yields, that they're somehow just going to do well. I don't know how that turns out. I don't know how that's going to happen. What narrative can potentially drive that? So anyways, again, if you guys like the video, consider dropping a like. Thank you for giving me some time to ramble. Take this video as you will, and apply it to your investment trading strategy. Above all, just stay safe. But until the next video, everyone, I'll see you all in the next one. Have a great start to your week.